Every day the opening bell rings, the stock market acts as a highly efficient machine. It pulls capital away from the chaotic, reactive majority and funnels it directly to a quiet, rational minority. It's completely understandable to feel the pressure to constantly tweak your portfolio. You read the financial headlines, you hear about someone making a fortune overnight, and you feel the urge to optimize, to predict where the economy is heading, to trade actively just to protect your cash. But paradoxically, all that frantic activity usually destroys your returns. Warren Buffett has a very clear framework for this. He argues that your survival in the market depends entirely on knowing exactly which of two investor camps you belong in. This chart is your baseline diagnostic. Do you have the time to study individual businesses every week? If yes, you are an active know-something investor, but must avoid specific traps. If no, you are a passive know-nothing investor whose only job is avoiding emotional self-sabotage. You must pick your lane right now. The fastest way to blow up your capital is to adopt active trading tactics while only putting in the passive amount of effort. This chart maps out how different actions affect your actual returns, plotting the level of effort against the probability of making money. If you spend hours analyzing inflation data or interest rate hikes to predict market dips, you land squarely in the high-effort, low-return zone. Trying to time the market based on macroeconomic news is a losing game. There are dozens of complex variables moving the economy at any given second. In reality, not even Federal Reserve Chairman Jerome Powell knows exactly what the market will do next. This uncertainty creates the urge to do something every single day. If you feel compelled to constantly buy and sell, you end up swinging at mediocre pitches just to stay busy, instead of waiting for an obvious opportunity. The danger multiplies when investors use margin or borrowed money to maximize their returns on what they assume is a sure prediction. Borrowing money strips you of control. If you short a stock like GameStop based on weak business fundamentals, you might eventually be proven right. But sudden, massive price spikes will force your broker to issue margin calls, liquidating your position at a permanent loss before your prediction can ever play out. Trading daily and borrowing money trades the certainty of long-term compounding for the false comfort of short-term action. When the real opportunities finally arrive, your account will be illiquid. Looking back at the quadrant chart, there is another trap that lands in the high-effort, low-return zone: over-optimization. This happens when you obsess over micro details, like a single questionable lease or patent. Or you step over simple, profitable businesses to try and jump over a 7-foot bar in an industry you don't fully understand, simply because it feels more sophisticated. Investors often justify paying a massive premium for a stock by assuming the company will consistently compound its earnings by 15% or more every single year. This chart tracks the S&P 500 companies from 2012 to today. Out of those 500 massive corporations, only 40 actually managed to grow at 15% or more. That is a 1 in 10 success rate. When you pay an exorbitant price based on those aggressive forecasts, you demand absolute perfection from the business. The slightest misstep in execution guarantees you a poor return. Expending your energy on complicated forecasting wastes your capital. You trade the reliability of simple, cash flow businesses for the mathematical gamble of solving incredibly difficult problems. Even if you avoid leverage and stick to simple businesses, your own cognitive biases will push you toward irrational capital allocation decisions. Many investors get severely anchored to the exact price they paid for a stock, holding on to losers in hopes of breaking even, or rushing to sell winners to secure a quick profit. The stock itself does not show empathy. If you buy Amazon and it drops 40%, or you buy it and it climbs over 100%, the future potential of the company from today's valuation is exactly the same for both buyers. Treat every day as a blank slate. We also naturally succumb to confirmation bias, actively seeking out information that validates the choices we've already made while ignoring the data that proves us wrong. To counter this, you have to actively take what is known as the bear pill. Before you put a single dollar into a company, you must deliberately search out the worst-case scenarios and the deepest pitfalls of that specific investment. Without that discipline, it is incredibly easy to follow the herd. We abandon our own rules the moment we see colleagues or close friends getting rich quickly on a hot asset. Letting social pressure, ego, or arbitrary price anchoring dictate your money guarantees you will buy at the absolute peak of a hype cycle and sell right at the bottom. High-yield investing is ultimately a game of subtraction. It requires stripping away macroeconomic guesswork, leverage, and emotional attachment. This matrix outlines the two distinct paths, providing the exact rules of engagement for your specific archetype. If you have no interest in reading corporate financial statements, you are the passive indexer. Your strategy is simple: buy broad index funds consistently, strictly ignore the latest fads, and absolutely refuse to panic sell when the market drops during a recession. If you are willing to read the reports, take the bear pill, and wait quietly for years without making a single trade, you are the active concentrator. You must stick to simple businesses, keep a blank slate regarding previous share prices, and wait for the perfect pitch. When that opportunity arrives, you take a massive, concentrated bite. The most painful error for active investors is omission. Warren Buffett admits to costing Berkshire Hathaway $5 billion by sucking his thumb instead of pulling the trigger on Fannie Mae. Define your lane today. The stock market only penalizes those who step up to play the active game, but bring a passive level of discipline.